Hello and welcome to the India Hangout. It's another manic Monday of August 24th, 2015. One of the worst ever falls in the stock markets in India and surely in many other parts of the world, including several other commodities, including oil. The question we are asking more importantly is, can India survive a market meltdown? Does something like this expose fundamental weaknesses in the Indian economy? Or alternatively, if you were to look at it more optimistically, are there silver linings in this cloud? So I'm going to be joined by four experts to take us through this, plus some questions that are already beginning to come in. Shubhada Rao, Chief Economist of Yes Bank; Jyotinder Kaur, Principal Economist at HDFC Bank; Ajay, Bagga, Market Expert; and also G. Chokkalingam, another market expert and founder of Economics. Thank you very much for joining us. So Ajay, let me begin with you with a sort of slightly broader sense. Now, of course, the Indian markets have really cracked, and this in some ways is in keeping with the trend that we are seeing in other markets across the region and now surely across the world as well. So is this something that we are sort of going to move in a similar pattern and velocity with the rest of the world, or are we likely to go worse or faster than this?
Yeah, Govind, it's more global. That is one clear signal. It is China was really exporting out good economics, good growth in 2008. This time around, it has become the Great Mall of China, MAUL, where they have really exported out currency depreciation and stock market turmoil, currency turmoil to the rest of the world. So we have got caught in that because of the capital linkages. We get hit more, Govind, mostly because it's a more deeper market. We have seen that when gem funds are unable to take money out of some of the emerging markets, they turn to the more deeper markets and take out more. So Friday we saw selling of 2,500 crores. I suspect today would have been a higher level of selling, and today LIC might have been absent from the market because of the IOC OFS. So domestic institution money might have gone into that, which could have had an impact. So we would be hurt a little more, but fundamentally we are a better market.
Okay, fine. The question that I'm really asking is the Indian economy a little more vulnerable, and do events like this expose greater vulnerabilities than perhaps we believe? But before that, Chokka, let me come to you. What's your sense, of the route that we've seen in the markets? Now, while it is in keeping with what's been happening elsewhere, does this sort of open up more structural loopholes or weaknesses in our markets?
No structural loophole in the market, rather it's a structural change in the market pertaining to the participants. The dissemination of information now, compared to what it was 10 years back, is happening instantaneously. The technology also enables investors to execute the trades instantaneously. So consequently, today the Indian market has become victim of the global fear factor. But I am sure that our market would recover much faster than the other markets. The main reason is that the global pain also has some gain for India, which all of us know in terms of lower material costs, lower import bill. This is what exactly happened in the post-Lehman crisis. When many economies had even quarterly GDP growth in negative territory, India was the only country which avoided. So the pain has some gain also. I am sure market would realize it very soon. And as all of us know, that there's a lot of comfort on fiscal balance, current account balance. Even FDI inflow is quite robust at around 27%. RBI also has done two good smart moves, buying a lot of dollar in the market and also shoring up US bonds. So all this would come in handy and restrain the kind of meltdown we saw. I am sure within few days our market would start stabilizing.
Right. So, Chokka, let me put that question a little differently. I know the Governor, Raghuram Rajan, has been talking about a low current account deficit, fiscal deficit discipline, moderate inflation, and of course, strong forex reserves. Now, could we have perhaps weathered this better had our economy been a little stronger and more depth in the markets?
Certainly, they have done all good things, but except on the inflation front, I feel that it is a great miss. Because India was the only economy which was worried about the inflation. We were the only one sitting in the island of inflation worry. Had we cut down the interest rate much before, I think the industrial economy at least would have got some gain out of this, and they would have pulled up the economy, being near stagnation for last 2 years to some extent. So that's the only area of concern. Now I believe in a new environment, it is not only the US Fed which will abstain from rate hike. even Indian central bank would be forced to cut down the rate significantly. So that could be another trigger for the markets in the next couple of weeks or months' time.
So, Shubhada, I mean, the question we started with is, can India survive the China syndrome? Now, the China syndrome manifests itself in many ways, currency being one, the markets being another, but there are also other economic linkages between China and the rest of the world in India. So, what's the real damage that we're looking at that goes in some ways beyond the currency and the market numbers that we've seen on August 23rd?
Quite right, actually, Govind. While our domestic fundamentals are definitely far superior than compared to what our peers have, or even on a relative scale within India, what we saw in 2013 and what we see today is dramatically different. We are actually on a sounder footing. That's domestically speaking. What are the channels through which the repercussions would be felt? Obviously, through the capital flows, currency markets, and of course, the trade channel. Now, trade channel is something that we would be looking at more closely because very clearly, if I were to look at the real effective exchange rate, India would be exposed directly to China to the extent of about 11%. And if I were to look at Asia as a basket, maybe around 25 odd percent. So clearly, trade is one channel that would be looked at more closely, particularly where our export potential is concerned. But having said, I think India's exports in any case were getting more responsive to the global growth conditions and not just the currency movements. Now, if I were to look at the G4 growth prospects, they've definitely gotten better. And India has been, sending its merchandise exports and service exports to G4 to a large extent in absolute terms. Maybe incrementally we have been looking more at Asia, but in absolute terms we were still more, concentrated on the developed markets, so to speak. So I think trade channel is something that we would be looking at more closely. No doubt the currency forecasts are undergoing a change from most of us, but this is such a hugely volatile, moment that probably, as I was telling Ajay earlier, it's economists step aside and let the traders take over, and that's exactly what's happening. But having said so, the devaluation of China and a similar kind of perhaps a compulsion of the other Asian economies to devalue themselves, their currencies to remain export competitive, I think that will definitely, have some structural story to tell in so far as our currency levels are concerned. So quite clearly, our 64-65, forecast of a rupee definitely stands as a history, and more we would be looking at, further weakening of rupee, probably in a year or so to come, 66 to 68, if I were allowed to give a 2 rupee ban in these volatile times. I think that's where the rupee could be trading between 66 to 68. So that is one thing we would be looking at. But on a positive side, insofar as the commodity prices remain very, very subdued and on a downtrend, led by oil, of course, some of the damage of upside on or weakening of rupee could get contained till such time that currencies are getting offset by commodity prices. But yes, if commodities show some rebound and currencies continue to remain weak, we could therefore have some imported inflation threat. But at this time, I think it would be premature to talk about it.
Right. Okay. So you've I sort of noted your band, Shubhada. So let me ask Jyotinder this. And that's a sort of second question that we want to ask. I mean, can the Indian economy absorb a currency shock? If there is one, and in what manner could it manifest itself? Jyotinder, do you want to come in on that?
First, I think it's extremely misleading to kind of draw the market movements that we've seen over the last few days directly to fundamentals. This is a route, this is a market route, and it needs to be looked as that. So to quickly sort of jump into fundamentals and sort of bringing that into the picture, I think is jumping ahead of ourselves. Secondly, can the Indian economy sort of weather a currency shock? It's certainly better prepared than it was in 2013 during the taper tantrum episode, but I wouldn't quite sort of say that it's likely to remain unscathed. I think there's far too much emphasis being paid on the current account as well as the comforts that follow from commodity prices. Yes, of course, that will provide a floor to currency movement as well as markets going ahead. But in the near term, what we're sort of more concerned about is the development of new vulnerabilities and risk channels. Firstly, the higher exposure of foreign investors, both to equities as well as debt, local currency bonds. Secondly, the significantly large unhedged external debt of corporates, and as well as increasing reliance of the banking system to both wholesale funding as well as external borrowing. So, yes, the more conventional vulnerability indicators clearly point to the fact that India sort of stands out, but there are several other risk channels, which is why we've actually been beaten down to the extent that we have. I think we should sort of wake up to the fact that, there has been a significant loss, and, to sort of keep reassuring ourselves that, it will be okay and things will be all right eventually, is perhaps, I think it's falling into the trap of complacency. I think the only way that we will be okay is if we take correct policy measures, and those really haven't come in.
Yeah, Jyotinder, can you define that when you say? I mean, if I got that right, you're saying that while you should treat this as a market route, at the same time, do not underestimate the impact of the exposure that Indian companies or even banks have to the external sector or the external borrowing world. But you're also saying that we need to respond to this in some fashion. So how could we do that?
Right. I think, first of all, it's important to sort of get external liquidity channels flowing. The RBI needn't sort of intervene in the market, in the spot market directly. I think perhaps to sort of get some of the forex needs off the market, that would be a sort of a strategy that could be adopted. I think also it's eventually, once there is some stability in the exchange rate, there is this need for the RBI to acknowledge that we are not living in isolation, that, being fixated with the retail inflation rate is costing India its competitiveness in terms of pricing power. We have a severe problem of excess capacity in Asia. And, policy measures both by the government as well as the RBI need to be taken urgently.
Right. Thanks for that, Jyotinder. Let me come back to you, Ajay. So what's the sense that you're getting, the transmission between the market developments and the market route that we've seen versus the real world, which the real world in this case would be companies who are in the process of raising money, have raised money, are sitting on debt, and so on?
Yeah, Govind, clearly the debt levels are high for certain segments. NPAs are contributed by those segments. I think those companies will continue to suffer, especially the mid-cap, small-cap with high leverage, certain sectors with high leverage like power, like transmission, like infrastructure. I think those will continue to suffer. I think the one very big issue that we are facing is, highlighted by one of the brokerages yesterday, that nearly 42% of the loan outstanding is by companies who don't have adequate interest cover in terms of revenues covering the interest outgo on their bank outstanding. So clearly there is a lot of mess which is there in the banking system, which is not going away in a rush. You need very strong government action, monetary policy action in terms of cutting rates, in terms of giving relief to these sectors, and kickstarting the stalled projects.
Right.
I think all that is much needed.
Right. Ajay will come to that in a second. Let me just come back to the point that you made. You're saying that 42% of the companies with outstanding debt, they do not have enough revenue to meet their interest cost. Did I get that right?
Yes, that is a Credit Suisse report which came out over the weekend, which they have actually done a full analysis of the bank outstandings, and they have shown that 42% of that debt is with companies who don't have enough revenues to service the debt.
Right. Okay. Now, if you were to put what you just said in the context of the currency shock, how bad do things get from here on?
It can get very bad, if what Shubhada said, if it goes to 68 even, a lot of it is unhedged. RBI has been asking and making it virtually compulsory for companies to report to their banks that what is their unhedged foreign currency exposure. A lot of that goes unreported. So a lot of companies have been casual about this. There have been cases of borrowing in yen and hoping that with a depreciating yen, at the end of 2 years, 5 years, you end up paying virtually nothing. And now that that trade has reversed yesterday with a strengthening yen. And those could be issues that come to haunt, just like it happened in 2008. It is really uncharted territory, Govind, and that's why you saw a sell-off in the banks as well today. And those could be big issues for the economy also.
Right. So, Shubhada, can I come back to you quickly on the currency shock question? I mean, what's your sense? I mean, what could be the potential fallout, particularly in the short term, of a currency shock of the nature that we've seen so far?
Essentially, it's the same that what Jyotinder was also earlier talking about is we need to be now tracking what has been the dollar exposure of the Indian corporate sector. Though RBI has been reiterating on the hedging almost being made compulsory, but there are let's not forget rupee remained very steady for a very long time, around 64 to 65 levels for an extended period. Now that makes the corporate sector perhaps a little bit complacent about the rupee levels going forward. Hopefully we will see that perhaps the extent of unhedged exposures are not significant, and that's one obvious shock that the currency levels having corrected by about 2 to 3 rupees to a dollar would potentially have on the corporate sector. But I think it's before pronouncing it as a disaster, I think it's important to make a very careful evaluation of the unhedged quantum of exposures of the corporate sector before spelling the death knell on that. But having said so, I think it's going to be a volatile world for some months to come. I don't think it's going to settle very, very quickly. What it really stands for India in a good stead is that our domestic fundamentals are on a finer footing today, and the resilience therefore and the ability to for the RBI with the $350 plus billion of reserves, the ability for RBI to at least take care of the speculative element of trade in the rupee can be taken care of. What gets driven by the real effective exchange rate changes will be, I think, well within the RBI comfort. But anything that moves out of that and deviates significantly is where RBI could intervene. Right. But overall, I think, nobody is invincible in this world. In an interconnected world, I think it would be best to hedge, keep our bets safe, and that's how you deal with an extremely volatile environment.
Right, and prepare, as you said, for a 68 rupee to a dollar world. Okay, we'll come back to that in a moment. Let's ask the next question, right? So, how does this stock market crash affect investors, or what does this stock market crash really mean for investors? Chokka, let me begin with you.
I think the stock market is not likely to see many more crashes or shocks in the near term. Particularly not from the currency, because Lehman crisis came as a shock, and many corporate could not get the right message on the currency. Whereas this time RBI Governor himself was cautioning corporate about the stress on the currency post Fed rate hike. Now, therefore, I firmly believe that many corporate would have made good coverage of the currency. And secondly, I firmly believe that the Fed is not likely to hike the rate, in the change to economic and the market environment now. And third, any further devaluation on account of yuan rate change is most unlikely, because Chinese bank also realize the fact that there is a severe competition among many economies. So therefore, from the currency point of view, I don't see any shock to the stock market.
Right. Okay. So let me come to the stock market itself. Ajay, if you were to look at it from 2 or 3 vantage points, one is investors who've been here for a while. That could include foreign portfolio investors. Other is domestic investors, institutional, and then let's say retail. How is this played out from each of their vantage points, the way you see it, and how could it play out in coming weeks and months?
Yeah, Govind, as Shubhada said, FPI investors, the FPIs got used to a steady rupee. And what really roils foreign investors is if it's a volatile currency, because then MTM losses start coming in. So they would like a steady rupee most. India remains one of the most favored markets globally with good growth. I think that money will continue to keep coming in India. In terms of turmoil, when gem funds see outflows as they have been seen, you will see more money going out of India, as we have seen on Friday and probably today. Coming back to domestic investors, they understand the economy. They don't have any currency risk per se, and they would like to participate in the growth. Retail investors, 80 lakh SIPs are their systematic investment plans, which are bringing in about 2,500 crores per month into the market. And those will continue at least for 6 months to 12 months. That gives a lot of stability to the market. What really worries me is that we've seen a similar pattern in January 2008, when January 21st and 22nd, 2 days in a row, we saw 2,000 point plus corrections in the Sensex. That is a big possibility tomorrow that we see a repeat based on a very weak Europe and very weak US markets tonight, which is right now playing out. That could spoil sentiment a bit, Govind. But overall, the positions are very light. Less than 2% of Indian savings coming into equities, very little institutional participation, very little margin money as such. So what we saw today at about 11 o'clock and 2 o'clock, the kind of sell-offs in the market, that was based on some basket selling and some margin positions being removed. Now that will come in again tomorrow morning because of the sheer fall in the market. That margin impact will come in, but the liquidity is much better. The leverage is much less than 2008, Govind. So that will give strong legs to this market to stand. But the FPI pressure continues until that subsides. Finding a bottom for the market is difficult.
Right. Okay. So that's fairly comprehensive, Ajay. Let me sort of come back to Chokka on this. Chokka, what's your sense about where this market could go in trying to time it? I mean, should people be timing it at all? I mean, this is of course a question that could be asked every day. Or should people be sort of taking a step back and waiting for things to settle down, looking for global cues and so on?
No, people should not try for timing the market. Very difficult even for the experts, so-called experts like me. I would rather suggest that go by the individual stock, valuation comfort, also the comfort in terms of management quality and balance sheet. Because let us not forget the fact that, as I said earlier, because of the structural change in the market, not only the downside, even upside we saw, in 2009 May, even the whole market has hit the upper circuit breaker. So all these kind of, robust rise or fear-led crash in the market are going to happen again and again in the future also. So therefore, the message for the retail investor is that you stick to the good quality individual stocks and have a stock specific approach. And this market is amazing market for such investment strategies, because we have seen, irrespective of such falls, even post-Lehman crisis, people creating a lot of wealth in individual stocks. So I would once again reiterate that stick to the individual stock strategy.
Right. So Ajay, last question on the market fact, then we'll come back to the economy. Is this market correctly valued, or not correct may not be the right word, appropriately valued at this time, under, over? How should people be looking at it?
On a relative sense, Govind, India is normally overvalued. In terms of 1 year forward, we normally tend to be on a premium to the rest of the emerging markets, which is true even today. But on a return on equity sense, on a price to book value, we are not that overvalued. So that's a hedged answer I've given you. But my personal response would be that it really depends on sentiment. Right now, sentiments are bad. The momentum is negative on the downward, with a downward bias. But remember, when the market turns, it gives the full year's returns in a few days. So my recommendation to investors would be keep your long positions, stay invested, not a time to get in fresh positions that you wait for the momentum to turn. So let the market either stabilize or give a minor turn. That's when you build fresh positions. But right now, don't sell at a discount in a desperate situation. That's not the right way. And when the market turns, it will give the full year's returns in a matter of weeks.
Okay,
so
great.
you need to be invested.
Right. Okay. So that sort of, I guess, what should allay fears for most people, at least those at least who think long term. The next question and the last one we are asking is really, what are the silver linings in all of this for both the economy in a broad sense, but also the markets in specific? And Ajay may have alluded to some of them already. But let's come back to Shubhada. Shubhada, what can we take away in terms of good news, if any?
Good news is I think none of us are actually looking at revising our growth forecasts lower. We are still on looking at relatively a resilient economy, hoping that and I think broadly anticipating that India will tide over this current volatile scenario far better, and perhaps growth projections are not going to get dramatic. So I would think if domestically we concentrate on a couple of reforms in the coming months, it makes even growth look even better, over 8%. But at this time and point in time, I think growth is something that we would be looking at. Inflation has been behaving well going forward. We expect that to surprise us on the downside as compared to what RBI's indicative trajectory is. And on the positive note, I think we have not taken one more interest rate cut off the table. I think we are still penciling in one rate cut from RBI.
Right. Jyotinder, can I put the same question to you? What's the bright side of all of this, if any?
Right. So a lot of similarities with what Dr. Rao said earlier. Clearly, one of the advantages or disadvantages of sort of having the growth slowing down purely on the basis of institutional paralysis, policy paralysis, is the fact that the turnaround also lies in our hands. So we do have it in our if we do sort of get the policy framework going, if we sort of get the public capex side going, the recovery, though still fragile, could sort of remain very much intact. Secondly, the fact that China's looking shaky clearly does bring back the spotlight on India. And, it's still about 3 months ago, there was this talk of reallocation of funds away from India to China. We probably see that clearly sort of shifting again in favor of India. The fact that the rupee has corrected so much clearly then, creates some degree of competitiveness, especially in sectors where India has a relative comparative advantage, sectors like chemicals, furniture, textiles, apparel, so on and so forth. And lastly, of course, the fact that that China is looking weak and Asia and bringing Asia down with it, it really means that commodity prices are going to be lower. There's an excess capacity problem, as a result of which inflation or inflationary impulses into India will be negative. We'll be looking clearly at least 50 basis points of rate cuts going ahead.
Right. So the rate cut is more imminent today, it appears, from what I can gauge from what you've been saying. Ajay, let me come back to you. So what's the silver lining in this, apart from, of course, values are much more affordable at an index level of 25,700 or a Nifty level of 7,800?
Yeah, the silver linings are multiple, Govind. We have seen the government acts when they are really driven to the edge of the cliff. So I'm hoping that they get their act together and at least the executive level of reforms, they get really jump started. There was talk of the MAT being, the MAT overhang on FPIs being removed as per the AP Shah Commission being accepted. Things like that would be a booster for the market. Hopefully, the government acts fast on that. The commission report came in on July 24th. It's been a month today. Hopefully, there is some action on that. So, similar actions, if they get taken, that would be positive for the market. And normally, we act when we are very near to the precipice of disaster. So, that is one positive I see. Second is that the participation is low, leverage is low in terms of the investors. So they'll be able to have a lot of dry powder is there in the market, Govind, which I think around 7,400 levels, which are the pre-Modi levels. I think you will start seeing participation in the market once we hit those levels.
Right. So that's a fairly optimistic note to almost end on. But Chokka, let me get a quick 20-second word from you on what's the one or two bright things that you're looking at from developments of the last couple of days.
Oh, I mean, the FI is, the selling cannot be happened now because without much selling, the market already crashed. There will be a lot of margin expansion for the corporate because of the crash in the material prices. And because of this crash, even the government has to come out with the positive measures on, the MAT issues pertaining to the FIIs. And finally, I expect even the retail inflation to turn negative within few months or so, unless the monsoon in the remaining 35 days is a complete washout. So therefore, I see a lot more attraction coming from the domestic investors in the market in the next few weeks itself.
That's a fairly sort of broad and good note to end on. Thank you, Chokka, Ajay, Jyotinder, and Shubhada for sharing your thoughts, taking us, describing to us where things are headed or likely to be headed, the bad news as well as more importantly the good news. And this does seem to be, as we concluded, some silver linings in the great market fall of this year, at least both in markets and currency. Thanks for watching. We'll be back on India Hangout.